Good morning everyone and welcome to the 2016 June quarterly review for the Enhanced Yield Fund. Certainly been a lot to digest over not just the last quarter but indeed the last 12 months. We've had a couple of missteps in China, we've had Europe's seemingly endless commitment to quantitative easing, we've had the Fed finally starting to raise interest rates and then sort of more recently seemingly stalling in terms of their raising rates, and then just in the last couple of weeks we've had the UK's decision to extricate itself from the European Union, plus some machinations around the Australian election, and of course let's not forget the fact that just a couple of months ago the RBA decided to cut interest rates to an all-time low of 1.75%. So within all that, there's been a lot to consume, a lot to think about, and like I say, not just over the last quarter, but over the last 12 months. Now within that, probably the main point that I really want to get across today, or two main points really. One is that we find ourselves in a position where we've preserved capital over the year, which we think is a great result, and we've actually generated a small positive return. But more importantly, probably in some ways, is that we now find ourselves in a position to take advantage of the volatility that's being created in current markets. With close to 50% of the funds sitting in cash that we've been patiently sitting on, we're now in a position to go about starting to invest some of that capital, and indeed over the medium to longer term generate what we think should be a pretty good return for the fund, and indeed help it to deliver on its longer term objectives. So turning to credit markets, and credit markets have been a little bit all over the place over the last 12 months, as many people would know. Indeed, when we say look at investment grade credit spreads, for example, they're out sort of 30 or 40 basis points on average over the last 12 months. High yield spreads, or sub-investment grade as some people know them, out somewhere in the neighbourhood of 150 to 200 basis points, which is a pretty big move, although keeping in mind that earlier in 2016, calendar 2016, they were out sort of a bit over 400 basis points. But broadly, there's definitely been some weakness there, and consequently, markets are, I guess in some respects, still a little bit jittery. The most important thing from our perspective, talking about the substantial amount of cash that we've held in the fund up to this point, is that we're now in a great position to take advantage of opportunity. And I think it's important for us to talk about the opportunity set as we see it. A lot of funds are constrained to investing in Australia, and we think that that's really an errant way of investing capital. I mean, when you think about markets more broadly, most of the opportunity is offshore. When you think about the US and European markets, you're really talking about much deeper, much more liquid markets, and by and large, that should certainly come into consideration when thinking about where we invest capital. So in thinking about that, many investors will be aware that earlier in the year we were one of the only investors in Australia to take a position in the bonds of BHP. BHP at the time was really going through some operational issues with its major project in Brazil, and there'd been some pretty serious considerations to think about there, and also commodity prices in general, sort of post, I guess, that what I sort of call the second China misstep, had seen commodity prices, and particularly oil, but commodity prices in general, fall quite considerably. And there was a lot of noise around, there was a lot of panic in terms of what it might mean for BHP. Basically, we took a step back and really had to think about, okay, well, when we think about the BHP business, what are we looking at? And by and large, most of its revenue comes from iron ore and copper, two areas where they're one of the lowest cost producers in the world. So from our mindset, it really became a sense of, right, well, these guys are one of the lowest cost producers globally. How likely is it that commodity prices will be sustained below the costs of production of the lowest cost producers? And so that gave us some comfort that it would be a reasonable time to be investing, and at that point the spreads on BHP were quite distressed, again giving us a pretty good entry point. The way we invest capital, and many of our investors will be familiar with this, is that we're not just looking for good value in credit markets, but we're looking for the anomalies. What made this an anomaly was when we looked at not just the BHP debt in Australian dollars, but we looked at looked at it in US dollars as well, was that the US dollar note in the seemingly deeper and more liquid market was trading at about a 1% premium to where the Australian dollar note was trading. Now, there's a few technical reasons for why that might be, such as the big influx of superannuation money into Australia, propping up the local market and a couple of other bits and pieces. But broadly, when we look at it and thought, okay, well, I have an opportunity to invest in the more liquid, deeper market bond at a much higher yield, it made perfect sense. So we took advantage of that anomaly. And we found ourselves just a few months later, after BHP had announced a restructure to its dividend and capex program, that we were sitting on a substantial gain from that bond, and we ended up selling that asset a few months later at around a 6.5% absolute return for the fund. Really just as a function of knowing the BHP business quite well. It was a business that we obviously had identified a long time ago as being one of the key players and obviously one of the low-cost producers in that market, and thus we're in a great position at fairly short notice to take advantage of that position. In general, offshore markets have been a really happy hunting ground for us over the years. We've got over half of our credit assets, so our non-cash assets, invested in offshore markets at the moment, and consequently that's put us in a great position to build our universe and indeed look for opportunities that perhaps are outside the scope of what a lot of domestic funds are doing. So this investment is a really good example of the PM Capital process and how we think about investing, in terms of looking for investments that are not only nominally cheap, but represent what we think are anomalies in global markets. And really also just highlights that when you look at investing from a stock picking perspective, there really are opportunities to make money even in weaker markets. In terms of the outlook for markets, look, as I mentioned earlier, there are sort of a few key areas that we're keeping a close eye on. The US, obviously, the UK and Europe is becoming increasingly important, and also China. From the perspective of the US, everyone's sort of worried about the magnitude and timing of when the US will continue to raise interest rates. Look, at the end of the day, we think high Fed rates or higher US rates will be a function of a much stronger growth profile in the US. And so as rates go up, it'll be indicative of the fact that the US economy is doing pretty well. So we're less worried about that from a long-term perspective. In terms of the UK and Europe, look, there's going to be a fair bit of noise around short term, and indeed we suspect that the UK will take a bit of a hit, in particular to confidence, and growth will probably be pretty stagnant for the near to medium term. Longer term, however, I think that it may even be a positive for the UK in terms of just restructuring how it operates within the EU, but overall we don't think it'll be a material negative. Probably the biggest area to focus on from our perspective is China, and indeed, with some of the imbalances that you're seeing currently in China, particularly with regard to the property market and by association the banking system, who has obviously lent a lot of money into the property market. There'll just be the question of whether the imbalances that exist there need to be sort of cleaned out with a more material restructure, or whether incremental reform over time will be able to resolve the growth issues that China is going to face over the medium to long term. In any case, all of these market situations, I guess if you want to call them that, again, are in a sort of a framework within that there'll be pockets of volatility, and that's going to be great for us as investors with a substantial amount of the fund sitting in cash. We're in a great position to take advantage of the volatility as it comes along, and indeed will set us up nicely, we think, for the next few years. And so with a yield to maturity on the fund of around 3.75%, we think the fund's in a very strong position to deliver it on its long-term objectives. In the meantime, fund returns month to month are probably going to bounce around a little bit more than normal in both directions. But in the background, it's important to remember that we are investing capital at fantastic yields, which we think will set the fund up for a number of years going forward. Indeed, again, I want to reiterate the point that we think this is a market for stock pickers and not a market for just broadly investing in credit exposure, but indeed picking out what you think are the anomalies, taking advantage of them, putting enough of your fund in them to make a difference, and generating hopefully some pretty decent returns over the longer term. We've had a few questions over the last little while just with regard to whether or not we have any exposure to any of the UK property funds and seemingly growing number of UK property funds that have closed to redemptions over the last little while. The short answer to that is no, categorically. The reason that these funds have got themselves into trouble is effectively they're unitised, they have money coming in and out every day. They're trying to provide liquidity, but against a property portfolio that is very, very long term. And so what's happened is they've had too many redemption requests, they can't sell the property assets down in time, and they've had to close their doors to investors. That's certainly not our game. It's certainly not the way we access property in that sense. And consequently, the fund has been unaffected by any sort of exposures to those funds. We've also had a few questions with regards to the interest rate exposure in the fund, and indeed how much interest rate exposure we have and the rationale for our positioning. Look, the bottom line is we have almost no interest rate exposure in the fund at the moment, and the rationale for that is very, very simple. Interest rates around the world are incredibly low, close to zero in most places. A lot of countries have now seen part of their interest rate curve go well into the negatives. So you're actually paying for the privilege of putting money on deposit with some countries. It really just doesn't make sense to us. It looks to us as a much longer term anomaly. So we're very happy to not be where there is an incremental return at the moment. In some cases it's negative, but where there is an incremental return, we're very happy not to be generating that, but in the same breath also not putting ourselves in a position where we face the risk of material capital losses on a longer term basis. When you think about, say, a 10-year bond, for example, it has an interest rate duration of around about 9 years. So for every 1% move in rates, you're looking at about a 9% move in the capital value of a bond like that. So when you think about what a more normalised environment might look like for interest rates in some countries, and we'll take the US as an example, if you're looking at, say, maybe at least a 2 or 3% move longer term in rates, you're really talking about potentially in the neighbourhood of a 20 to 30% capital loss from an investment like that for an almost incrementally zero gain. That doesn't make sense to us. It's certainly not a way that we intend to generate returns for the fund over time, and thus we've got basically no interest rate exposure in the fund.